Some people say investing is simple, and few others say it's too complex and beyond their imagination, and they are not able to generate returns. Why does that happen? Because they are lost in the world of so many jargons and so many formula which are out there in investing world, and that's the reason it's very difficult to boil down to things which really matter. So in today's video, I'll quickly give you three most important objective factors and three most important subjective factors which you should look before investing in any businesses. It can boil down to so easy format, and I call this fundamental trinity of investing. So after watching this video, you will be very clear in terms of what to buy in stock markets. So let's jump in. So the first key factor to compounding on the objective side is excellent growth. If your business is having excellent growth and it can do so for many number of years, that is one of the key factor that will contribute to this compounding trinity. So growth could be in multiple ways. It could be growth into a new geography. It could be a new product, or growth driven by taking market share from other competitors. So there are multiple ways in which a company can grow from the top line perspective and the bottom line perspective. But ultimately, growth is what matters in terms of compounding. That is one of the most important factor you should be looking for. The second one is return on capital employed. If whatever you are investing, it's lesser than cost of capital which you earn, then there is no point in growing, right? Let me give you an example. So suppose you take a loan of 10% for your business and you are getting 8% return from the same business from that money. In fact, you are not working for your business, you are working for the person from which you have taken the loans. So it's very important that your return on capital employed should be much higher than cost of capital, at least equal to cost of capital, just to break even. And then you should be able to reinvest those cash flows which you are able to generate into your own businesses at a higher ROCEs, which is return on capital employed. So this is the second most important factor which you should look for, whether the growth is there. And the second is whether your ROCE is greater than cost of capital and whether you are able to reinvest your cash flows in the same business. And if you are able to grow without reinvestment, that's perfect. But generally, traditional businesses will need reinvestment of cash flows to further grow their businesses. Quote I which wanted to share with all of you is on the lines of the same concept which I just talked to you about, which is, what is this magic of high ROCE, or return on capital employed, and longevity? So what did Charlie Munger say on this particular concept? Over the long term, it's had for a stock to earn a much better return that the business which underline it earns. If the business earns 6% on capital over 40 years and you hold it for the 40 years, you are not going to make much difference because you are just breaking even in terms of what price you are paying for. So even if you originally buy this at a huge discount, you are not going to get much because ultimately, the business will give you the return based on what underlying returns, intrinsic compounding of the business. Conversely, if a business earns 80% on capital over 20 or 30 years, even if you pay an expensive looking price, you will end up with one hell of a result. That is the power of compounding of the intrinsic value of the business if it can grow continuously for a long period of time at a much higher return on capital. Right? So this is the powerful quote of Charlie Munger, which I wanted to share here. Now, the third concept which you need to see is whether the business has good return on equity, because ultimately you will be investing as a shareholder, and whatever return it generates, it matters on the equity part of it, not the overall capital. Of course, it matters and that gets captured separately, But ultimately, as a business owner, you want what is the ROE of the business which I'm getting in, right? So these are the three compounding trinity which you would need to go deeper before investing into any business. And by the way, if you like the content of this video and like this channel, you can just subscribe to this channel so that whenever I'm posting a new video, you will get a real time update. You can just hit on that bell button and it will be real time update for you, right? And now we are going to go deeper into three factors which are subjective factors, which is difficult to measure, but you need to understand those factors before investing. Not just one, this triangle, but the blue triangle is also equally important, and that's the reason I've put in yin yang a symbol in the middle of this particular PowerPoint, right? So let's go deeper into next three compounding trinity on the subjective side which you should know. So first is longevity of growth. So if one company is growing just for 1 year or 2 year versus a company which is able to grow for many number of years, that's much more powerful. So you need to focus on not just growth, but what is the longevity of that growth. And again, it's a subjective topic. You have to understand the competitive forces, how the entire sector dynamics is looking like, what is the product profile, how is the management, and a lot of things goes into understanding for the longevity of the business. So this is the first compounding trinity on the right side, that is the subjective side of investing. The second compounding trinity is to identify reasonable valuation. Because if you pay very high price and you are investing for just few years, then there are chances that there will be derating if the growth is not there, and you might be caught on the other side even if the business is reasonably good. So it's always good to have growth at reasonable price, and that is where the concept of valuation, understanding about the intrinsic value of the business, and understanding the overall prospects of the business is key to this. Okay. So this is the second compounding trinity which I wanted to share. And by the way, in my community where we go deeper into all these factors, we dissect each and every factor and try to make a sense out of it. So if you are interested to join this community, you can just click the link below which I've posted, or you can just type in your browser technofunda.co/webinar and I'll tell you more about it. The last factor, which is one of the most critical factor again, although it is the last but not the least, is a company having a robust business model. If the business model itself is shaky one, then it's no point investing for long term in those businesses. So it's very important to understand the business model and assess that it is a robust one. And along with this, it's important to have a capable management with a good capital allocation skills. So where the money is getting invested by the management is also very, very critical, right? So this is the final and the third compounding trinity on the subjective side. These six factors broadly, if you are able to conquer before investing in any business, then it will take away a lot of your hard work. Okay, but these are the most important compounding trinity principles which you should look before investing into any businesses. Okay, so hope this entire formula was useful to you. If you found this useful, just write in the comment how did you feel about the entire video. And if you want to have some more videos on these lines, just put in the comment box so that I know what you like, and next time I can produce a video on those lines. So thanks for watching, and we'll see you in the next video. Bye bye.